Hello and welcome to another Macro Mondays. Though we have decided to film this on Friday, we've just had some pretty big US economic data, the monthly payrolls. They've come out very strong and we're seeing some stresses in the market. So we thought we'd bring this forward to be more accurate to the data. My name's James Brodie and I'm Head of Learning and Development here at Onyx Capital Group.
And my name's Will Cunliffe, a research analyst here at Onyx Capital Group.
So today we'll start by looking at the much stronger than expected US payroll data. That's making the dollar much stronger. US yields are tightening. The yield curve is steepening. And with that, we're seeing weakness, much more weakness in the equity market and cryptocurrencies as well.
We'll also be taking a look at yields in China. We've had some weak inflation data pointing to continued weakness in demand there. We'll also be taking a look at oil markets because there's been some pretty exciting price moves today.
So today we had US payrolls, the key economic data. The market was expecting 165,000 jobs to be created last month and unemployment rate to stay at 4.2%. The risks were the data was going to come out weaker, but it actually came out far stronger. 256,000 jobs were created and the unemployment rate fell to 4.1%. So what we saw was yields jump much higher. As you can see from the chart here, the 2-year yields have suddenly jumped to a key resistance level. The dollar has surged higher. Euro's heading towards parity. The Asia currency index is at 20-year lows. And really beginning to see the equity market starting to break support, cryptocurrencies as well. So bonds down, equities down, crypto down as well. There's certainly some signs of risk in the markets.
Yeah, I think a key aspect that the markets will be monitoring is, how's the Fed going to interpret this data? At the last FOMC, Powell was really quite focused on the labour markets when defending two cuts next year, even despite their projections showing PCE inflation heading up to 2.5% from 2.4% in 2024. And I think, really the market is questioning whether they're going to need to cut at all now. So we've seen the first cut price in the US move back from June to September. And with that, we're seeing the steepening in the yield curve. Break-evens, 5-year break-evens rose 4 bips on the release, and sits 14 bips from levels at the start of the year. So yeah, the market's looking for more inflationary pressure next year, I think.
Yeah, so having looked for all the cuts, the OAS is now pricing 33 basis points of cuts this year, and the terminal rate down at down at 4%, much higher than previously expected.
Yeah, and we're also seeing, services PMI prices, for example, printing much higher. So they printed at 64.4, up from 58.2 in December. So I think, the Fed is going to be watching inflation data closely.
Yeah, we actually had some hawkish Fed comments this week. Fed's Bauman said, inflation's elevated, I see upside risks, progress has stalled. And also, Fed's Bostic said expects inflation to decline, but warns Fed to be cautious. We also had actually really strong Canadian employment data today. So Canadian economy had looked very weak. Unemployment came in at 90.9 thousand jobs created over the month, only expected at 25,000. So that's a huge beat. And the unemployment rate was expected to come in at 6.9%, fell, it came in at 6.7%. So strong data all round, and more tightening of financial markets, yields going up, curve steepening on a week where we've seen a lot of stress in the bond markets, particularly in the UK, which we'll come to in a second. So again, is another currency crisis brewing? You can see here the Asian currency index has fallen to its lowest levels in 2 decades. And if you look from a perspective of an Asian country, look at commodities. Commodities are priced in dollars. The dollar's getting much more expensive and commodity prices rose over 2%. We have a slide on that a bit later. We had a huge move in oil today. We have a slide on that. So there's definitely increased stress levels with the dollar going higher. Definitely. And yields going higher. Mortgages are going to be impacted. We have data on that as well. And with the dollar getting so high, it's through 109, heading towards 110, the dollar index. Will Trump, when he takes office, talk down the dollar? He did in the last time he went into office. You can see from the chart here, you can see what the dollar did from election date. And when Trump took office, he immediately started talking it down. Well, what we've seen in the last 3 months, it's really highly correlated.
Yeah.
And we know how Trump wants to defend the US economy, and he's certainly going to try and talk down the currency. He's already tried to say the rates are too high. He wants the Fed to cut.
Yeah.
He wants to expand exports.
Yeah. And I mean, it makes a lot of sense from the US's standpoint. He wants to be a big domestic producer again. He wants a revival in US manufacturing. So yeah, with the strength in the dollar, that's going to be very tricky, especially with Chinese exports being so competitive.
And with the PBOC allowing the Chinese yuan to decline as well, that's going to be another, how do you say it politely, a contentious issue.
Yes, yeah.
And so what has this done to equity markets? This is one of the reasons why I decided to film on Friday, because it's had a sudden impact on equities. The S&P you can see here, well, technical analysts would probably call this a head and shoulders level, but you can see the market was in a clear uptrend. Over the last 4 to 5 months, it's gone sideways. You've now got lower peaks, but it keeps bouncing off the 5,828 level. Well, until today, it's broken down through that. So we know the market, we know this has been going up aggressively since COVID lows, and we know the market has record amounts of longs. We know retail and asset managers have huge, professional traders, huge long positions. What do you do when it starts to break new lows and break support? Well, the smart money tells you it's time to get out. Yeah. And that's why typically you see increased selling at these levels. So we have seen the same on the Nasdaq. It's breaking support. Bitcoin, actually, we mentioned last week, is very highly correlated. That's just above support. But we're starting to see some stress and fear in these markets. And again, if this breaks lower, you're going to have a combination of bonds going lower, equities going lower, crypto going lower. Where does money head?
Back to commodities, back to gold, your other inflation hedges. You know.
Yeah, we have the chart of gold in a second, and that is starting to trend higher.
Yeah.
Last week, well, we're talking about that on Wednesday, or this week, I should say. The Nasdaq had its biggest volume day ever when it went down 1.8%. Posted its single largest daily volume in history with 13.4 billion shares trading. If you look at technical analysis, you know that volume is often used to confirm trends, and when volume goes up on a down move, that tells you that selling is intensifying. So another interesting statistic. Mm-hmm. So the US yield curve is continuing to steepen, historically correlated with weak equities. You can see here, this is the 2s, 10s. Again, from a technical perspective, you can see clearly the white line shows when the curve was flat. So the curve had been inverted for, I think, around 2 years.
Yeah.
People had talked about recession, and the curve has finally started to steepen. The zero level, a flat curve, when it got to zero, the 2s, 10s, then that acted as resistance. Once that broke, the market came back and tested it. It acted as support. And now you can see it's been a fairly clear and near perfect trend, really, for the last month and a half.
Yeah. Well, as soon as, the hawkish narrative started to emerge from the Fed, we've really seen a bear steepening in the yield curve emerge, quite dramatically, actually, as the chart shows.
Yeah, an interesting point here is when the Fed's going to be cutting less, well, it means the front of the curve is going higher. Yeah. So what we're seeing here is, yes, the front of the curve's going up, but the back of the curve's going up much
Even
higher.
more, yeah.
And the problem for consumers is that's where mortgages are linked to. So we'll see in a second, we'll see mortgage applications are suddenly declining quite rapidly, which can only do one thing to house prices.
Yeah, exactly.
US bankruptcies. So on a bit of a more sour news, US bankruptcies continue to jump. Small businesses are hurting. Bankruptcies up to the highest level since back to the financial crisis. And this is small businesses. One thing we're seeing in the US is it's small businesses that are really hurting. The large businesses were able to roll over their debt at lower levels.
I mean, the Russell 2000 today down 2.2%. High interest rates really hurt the smaller businesses where, they're taking on a lot of debt. They probably don't have particularly preferable rates. And when rates don't come down as quickly, you can't roll your debt lower. So if you believe you're going to be able to roll your debt lower, as many people thought they were going to be able to only 6 months ago, that presents a lot of cash flow issues, and we're starting to see that pass through into bankruptcies.
Interesting. And for consumers as well, consumer credit had its largest monthly decline since COVID. You can see here, revolving consumer credit collapsed $7 billion in the month of November, its largest drop since the financial crisis outside of COVID. So looking pretty bleak for retail consumers and for small businesses as well. So while the key service ISM data is coming out strong and employment data is coming out strong, we are seeing a lot of weakness elsewhere in the economy.
Yeah. I mean, higher rates are going to be having an impact, especially in credit markets.
Yeah. And even though, as you say, the Fed did cut rates, what we're seeing with the yield steepening so much at the back is that's going to have a lot of financial tightening.
But interestingly, corporate spreads over treasuries are still pretty narrow. They've ticked up slightly, but especially high yields, they're still near kind of all-time lows.
It's a great point. There's no sign of stress there.
No.
And it'd be interesting to see the impact. I've not looked at that today, but now we're seeing equities starting to fall. You'd expect that to starting to widen.
Exactly.
On to China. Chinese deflation fears continue. We had CPI come out this week and PPI. CPI came in lower than expected, plus 0.1%. So marginal inflation. But PPI still entrenched in deflation, down 2.4%.
Yeah.
Again, more concerns for the Chinese central bank here, and we can see the yields. The 10-year yield, again, the circle highlights when we had the huge stimulus. We had a massive sell-off. 2 days ago, it looked like a bounce, but today we saw more selling coming back into, or buying coming into bonds, and the yields going lower.
Yeah, I mean, the PBOC have a challenge on their hands. They've had declining yields on CGBs for quite a number of years now, really, and they've tried to kind of intervene. They've had some interesting facilities where they've been borrowing CGBs from the private sector to then resell. But it's to little avail, really. When you're really struggling to have any sort of inflation, you can't expect the yield curve to be strongly contango. But the PBOC will probably continue to intervene more next week, I think.
Yeah, and what's going to be really interesting is to see how the market reacts on Monday to the US equity sell-off today. Because if we go on to the next chart, you can see the CSI 300 index here. That sold off today and it's breaking below the post-stimulus lows. So again, here as we mentioned before, we had Goldman Sachs looking to buy at the peak. We had David Tepper, Appaloosa Management saying they were going all in. That was at the peak in September, where it's now not only sold off, but it's going through the lows. All those long positions are hurting. And on Monday's open, this is going to go down surely on the back of today's news. If there's a chart we have, I mean, the S&P is a favourite today. Yeah. That sounds pretty bad. In the fact that it's the most interesting chart, but this is probably the next one.
Yeah, I mean, a lot of that strength that we saw kind of in September was purely stimulus related, and there was a finite capacity on that facility, the share buyback facility, for example, and that will be starting to run out now. So unless the PBOC come in and inject more into equity markets, there's nothing holding up the CSI 300.
Yep. Yeah, good. Interesting to see how the market opens on Monday. And interesting the opposite direction that yields are going in Europe and North America to China.
Yes, yeah. Well, it's the overcapacity all the way down the supply chain. They can just flood Europe with steel, flood Europe with petchems.
And that'd be interesting to see the impact. We've talked about that would, in theory, have a more deflationary impact on Europe, but we had some pretty strong inflation data out of Germany in a second, which we'll see.
Yeah.
So as he said, if bonds are going down and equities are going down and crypto's going down, well, one thing that's always going to benefit from that is gold. The chart shows that gold's starting to trend up again. There's resistance, the two previous peaks, 2,716 and then 2,774. But we're going to see more money flowing in there. And what we've actually seen is the Chinese central bank, PBOC, they bought 10 metric tons of gold in December. For the second straight month, they were adding to their reserves. So we saw the first half of the year they were buying aggressively. Then they stopped. Now we've had a sell-off. They're going back in. And I think this is definitely, we're going to see more money flows. And I think it's just a matter of time before we see those peaks taken out and new highs.
Yeah, I mean, we see a similar thing in commodity markets. After 2008, when a lot of commodities collapsed, who were the first to come in and buy? China. And we're seeing the same now. As soon as Dubai or crude hits the $70 floor, who's coming in and buying? It's China. So when they see a price that they like, especially if they perceive the yuan to devalue somewhat in the coming months, perhaps now's a good time for them to buy.
It's a great point we were discussing before we came on air, and you discussed on the podcast yesterday that if they're going to devalue, which would help their economy, and seems highly likely, then you want to be buying as much commodities as you can now.
Yeah.
So back to Germany, inflation jumped 2.9% year on year. It was expected to be up 2.4%. That's a massive miss, a concern for the ECB. But we also saw weak data elsewhere. German industrial orders fell month on month 5.4%. This was on the back of a fall of 1.5% the previous month. Also, Germany saw 4,215 corporate insolvencies during the fourth quarter, the most since the financial crisis. And on the final bit of bad news, unemployment in Germany has risen for the longest stretch since reunification. It's all bad news in Germany, and the ECB need to cut more aggressively. And I think the chart we have here is euro dollar. It's just a matter of time before euro dollar breaks parity.
Yeah, definitely. I mean, it's very. I mean, Germany used to be the manufacturing powerhouse of Europe. Now they've got to compete with China, and you can't, right? You can't compete with Chinese
especially
exports.
The cost of power and electricity.
Exactly, and especially in the automotive sector, they've lost comparative advantage there, carbon pricing is affecting industrial Europe. Energy prices, like you say, TTF's been rising recently because of the cold weather. Diesel's also been rising. So there's a lot of challenges facing Germany from an industrial perspective. And I wonder, is ECB cutting going to be enough? Is that going to support them enough to be able to regain that comparative advantage?
And the problem as well with the currency going lower, it means the dollar's getting stronger again. That's going to irate Donald Trump even more.
Yeah.
But I don't know. The two economies, such diverse directions here.
Yeah, massively.
And in the UK, a pretty important week in the UK. The bond market in the UK really is the one that's beginning to creak the most. Is another bond crisis looming? Well, on Wednesday, the UK 30-year yields were up 11 basis points, the highest level since 1998. Only different really to the Liz Truss crisis is then it just happened much quicker, but it seems to be, it's all heading in the wrong direction.
Yeah.
1 month currency sterling, 1 month implied volatility soared to 10%. And what we saw in December as well, house prices fell 0.2%. They're expected to rise 0.4%. So, we're starting to see here the impact these yields are having.
Yeah, and I mean, one concerning thing here is the combined effect of yields higher, but also sterling down. Often, for example, a lot of the dollar strength could be in some ways attributed to the higher yields in the US. Whereas when you have pound down and yields higher, that's that screams capital flight. That's people closing positions and getting their money out of the UK.
Yeah, it's a really good point. We've highlighted before here correlations between interest rates and currencies.
Yeah.
And higher yields should say higher currencies. But when higher yields say lower currencies, that tells you fiscal concerns. People are selling bonds and they're getting their money out.
Yeah.
Selling the currency with it.
Yeah. And in the US, it would seem that the high yields are not so much fiscal concerns. Perhaps they should be, but the credit default swaps, for example, have barely budged since Trump won the election. So I don't think necessarily fiscal concerns are the driving force there. It's more inflation and Fed policy.
For sure. And the chart you have here is sterling against the Japanese yen. So we're seeing the Japanese yen rallying on certainly strength. They have wage prices, wage rates are going up, which they've been pushing for. In Japan, actually, they've been desperately trying to get inflation now, really for 20 plus years. So, in fact, as well, Japan, the OIS is pricing now terminal rates a year's time at 0.73, pricing 50 basis points of hikes.
Yeah.
The previous high in rates in 2000, I think it's 2008 and 98 was 70 basis points. So now the market's pricing rates higher. And it's good for the currency there. And so we're starting to see finally a reversal in that yen cross trade.
Yeah. And for a long time, with yen at like 150 against the dollar, that's a problem for Japan. They're a big importer as well as exporter. A lot of raw materials they're buying in dollar. They're a big importer of crude, for example. So that presents a lot of issues for them, and we've seen that in vehicle sales. So Toyota's been really struggling. A lot of vehicle exports that were coming from Japan are coming from China again. So anything they can do to support the currency, I think, is going to be beneficial there.
Yep. And going back to that chart, it's trading at 193 at the moment. The high was got up to 2008 in September, just before the actually that's earlier in the year, just before July, August in the summer, just before the aggressive unwind of the carry trade. So the high is 208, I should say, currently at 193, but the lows of COVID and the financial crisis, it got down to trading around 116. So they're huge moves. Huge potential for that to carry on lower. And on to Japan. Japan's base pay rises the most in 32 years, helping the rate hike path. Positive headlines coming out of there. The one country that actually does want to see positive wage growth, having been in deflation or on the edge of deflation for so long. So certainly the dollar's very strong at the moment, but the yen is gaining traction, particularly against, as I say, the pound this week because of the bond market stresses, but actually today the Aussie yen is selling off quite hard. That's typically correlated pretty highly with equities. Onto oil, huge move in oil today. You remember the chart, the long-term chart, we've been looking at this long-term resistance, long-term support, and we've finally broken out this week. Happy to put my hand up and say when I'm wrong. I thought this was going to break down on lower global demand, but it's broken up. And that's the beauty of technical analysis. Just watching the price action, it's going up. So if you want to be short, then the best thing to do is get out of the market.
Yeah, I mean, the fundamental picture, as you said, is pretty bearish. I mean, in our oil balance, we have like 1.1 million barrel builds for 2025 in implied inventory changes. It's pretty bearish as far as forecasts go.
So that means there's basically expecting 1.1 million barrels of excess capacity.
Excess supply over
each,
demand, globally.
Each day.
Yeah, so that's obviously very bearish. But then again, we're seeing a lot of buying from China, like we were talking about earlier. The expectation of potential yuan debasement is going to incentivize stockpiling ahead of that. And we've seen in the Dubai window, TOTS are buying really, really aggressively. They've already bought 2 million barrels this month in the Dubai window. And that's all going to China, is what's believed, according to our sources at least. So that's really supporting prices, and that's dragged up the whole Dubai structure, which then obviously opens up the arb to Europe and and the Brent complex as well. And today we saw Brent front spreads rally up to $1, and we saw flat price breach $80.
It's been a huge move today. Brent started at 77.40. It's been up to 81, trading at 79 when we stepped in here.
Yeah.
Who knows where it is now?
Yeah. I think it came off a little bit as well. It sold off towards this like 78.50 range. So yeah, huge day in oil, super volatile.
Yeah, what I find really fascinating about oil, in the last year, we've had, obviously OPEC can drive the oil price.
Mm-hmm.
We had a period of months where it was highly correlated with the US interest rates, and we looked at from a demand perspective of the US strength and recession.
Yeah.
And what we see now, all of a sudden, it's being driven by demand from, as you say, buying out of China from Totsa in the physical window.
Yeah.
So many different things take place that can drive oil at different times. Of course, I'm forgetting the other big driver of oils being Middle East, the unfortunate events in the Middle East as well.
Also, the diesel crack has been rallying pretty aggressively. Heating oil demand has been going up a lot. That's been supportive of oil. We've also seen a lot of short covering. So that was probably what drove the big spike today. That drove us over $80 was short covering.
Yeah, and this is typical when you get markets as narrow as this, ranges as tight. When it breaks aggressively.
Yeah.
It's not just stopping out, as well as people jumping on board, the trend following.
Yeah.
So big moves there today in Brent, in oil. Huge moves all around.
Yeah.
And with that, commodities, an interesting chart here. The Nasdaq priced, or commodities, I should say, priced against the Nasdaq. And you can see it looks like, a commodities finally making a comeback. We talked about equities looking weak today, breaking support. Bloomberg Commodity Index is up 2.4% this month. Gold's in an uptrend, Brent spiking higher, copper, platinum, beef is at all-time highs, agriculture products as well. Interesting to see if we see more flows into commodities.
Yeah, definitely.
As equities fall. And Bitcoin, cryptocurrencies, can't go without mentioning crypto. Huge move up since Donald Trump won the election. Gone sideways. Last week we showed this correlated the S&P, the really highly correlated risk assets at the moment, the whole risk on, risk off. It looks like we're moving to risk off. The only difference here between Bitcoin and S&P is, as we stepped into this room, S&P had broken below the neckline, and Bitcoin here just sits right on it. But again, if you were long, if you're long and unemotional about your position, this would be a responsible place to take profit. Some people just buy and hold; they're willing to hold forever. But if you're trading, especially trading with leverage, now if it breaks this support, it's trending down. That's a good level to get out.
Yeah.
The key level actually there is at 91,370. So that's a key support. But I think, again, we're going to see much more in the news over the weekend about risk selling off. On a completely different note, we've touched on this before, but an ongoing concern that's going to get bigger and bigger over the next 5 to 10 years is population growth, or lack of, I should say. Statistic I saw this week, the South Korean population collapse. There are now more 84-year-olds in South Korea than 1-year-olds. Again, we need immigration in countries. It's becoming a very hot topic, very controversial topic. Or we need to produce more babies, but it's going to be a concern for governments and economies over the medium to long term for sure. OAS pricing for the next 12 months. We've already mentioned the Fed, just 33 basis points of hikes priced. ECB, the market's still looking for, 33 points of cuts priced by the Fed. 4 cuts by the ECB. Terminal rates in a year's time, US at 4%, ECB at 2.8%. ECB at 1.95, I should say. So a big disparity there between where the market's seeing US and European rates. Sterling 421. So the market's only pricing in 48 basis points of cuts. Of course, it the central bank are going to struggle to cut if we're seeing inflationary concerns.
Yeah.
But again, if the wheels are starting to fall off the bond market and the currency is getting weaker,
they might have no choice.
They might have no choice. Yeah. And we've got an interesting week next week because we have UK PPI, CPI, and retail sales.
Yeah. At one point of contention on the inflationary story is going to be energy prices, because we've enjoyed quite a deflationary base effect from energy, which it will be dropping out soon. And also we've had spikes in TTF, and just this week we had UK power prices on the spot market jump to over £1,300 per megawatt hour in a few hours because of grid supply issues. So that's going to be one inflationary source I think that's going to prove problematic.
Ironically, the day after the government were applauding themselves the fact that we were producing more power from wind generation than gas, a day later there was no wind, and as you say, prices spiked pretty highly, and that's going to be inflationary.
And I mean, it's happening more globally as well. Like I remember in 2021, I think in the ERCOT Texas grid, day-ahead power prices jumped to like $8,000 per megawatt hour when there was the freeze then in February. So yeah, things could get volatile, and that could be inflationary.
Yeah, and we've seen it already in Germany the last few months, and of course we're expecting now. It looks like it's going to be a much colder winter than expected.
Yeah, definitely.
And of course, when it's this cold, there's no wind.
Yeah, I heard January, coldest January in 11 years is expected to be. So.
And the final one, looking at those of interest, the BOJ, 50 points of hikes, price terminal rate at 73. That's now breaking new highs. So again, interesting trade is buying the yen, especially if we see equities fall, because that typically would be seen as a risk-off trade. Yeah. And final chart to look at, interesting one, Nvidia. There's a clear double top here. Again, it's a very, crowded trade. It's very popular with fund managers, asset managers. Key support level, the previous low, swing low here, $127. If it breaks below there, it's clearly a downtrend. We'll see more selling, so that's one to keep an eye on. So we have a pretty busy week ahead. We don't know what day it comes out, but some Chinese money supply data. On Tuesday, we have US PPI, National Federation of Independent Businesses, Small Business Optimism. Again, it looks like that will be quite bleak. Wednesday, we have US CPI and UK CPI and PPI. Again, it's going to be critical for the UK bond market and the currency. Yeah. Thursday, US retail sales, UK monthly GDP and industrial production. And then on Friday, US industrial production, UK retail sales, and China house prices and GDP. So Will, there's a lot happening. Markets, bond markets are creaking. It looks like equity markets are starting to creak as well. Yeah. What are your closing thoughts?
Yeah, I think it's going to be, it's going to be an interesting week next week. I think, especially from the UK CPI perspective, I'll be looking at that closely, and US CPI, of course. The Fed doesn't use US CPI in terms of its policy target. It uses PCE, but you can usually gauge where that's going from the CPI print. So that'll be particularly interesting. But yeah, I think it would take a pretty weak print to change anyone's view on what the Fed's going to do. I think they're going to be on pause for a while.
Yeah. So my key takeaway is two things really. Firstly, volatility is picking up across markets, and secondly, equities are moving into downtrend, which we've not seen for a long time. Yeah. And of course, with volatility picking up, we also have Donald Trump's inauguration, and I can't see him putting a lid on volatility.
No, I mean he's rumored to be signing 60 bills into action on his first day, so he's gonna be busy.
Come in with a bang.
Yeah.
It's going to be interesting times. So focus on risk management, and good luck with the week ahead. Thank you very much. Have a good week. Bye-bye.
Thank you.